What's going on in technology? The NASDAQ is down over 5% this week, as we mentioned. The tech industry is down more than 7 days this week, and we're having the worst week in roughly 18 months. What is the status of that trade? Since Nvidia had a strong figure last week, I believe tech showed its hand, but it plummeted. Therefore, when stocks decline on positive news, you can be sure that there is either a crowded trade or a negative development on the horizon. Naturally, they have led the downside this week. Because tech is a large holding and individuals want to reduce risk, I believe it is a component of this pull-forward seasonality. However, I believe there may be a political component to this as well. In fact, Trump's chances of victory rose this week in both the polls and the betting markets. Additionally, I am aware that investors believe he will be tough on China, which would hurt semis. Therefore, I believe that some of this may be due to concerns that Trump's victory may harm semis. What if these stocks currently have too much priced into them? Even though you have argued that these equities are the best in the world, valuations have gotten a bit too rich, and you may even be more interested in this place than any other. What if the multiples still don't make sense, even if that is the case? I believe it's feasible. Nvidia has experienced 30% drawdowns nearly 8 times as large in the last 10 years of its existence. At the base of those drawdowns, its P/E, Nvidia's projected P/E was actually higher. Nvidia's forward P/E is currently in the mid-20s. Therefore, this appears to me to be typical profit-taking. In my opinion, that will be a true gift in 2 years, even if it brings Nvidia back to the 1990s. Are you a buyer on the drop after considering all of these? Do you encourage those who read your work and hear you speak here and elsewhere to do that? Since, let's say, we estimated that there would be a 7 to 10% chance of a 7 to 10% drop between now and November, we're almost there. We have now dropped about 5%. We might be close to pulling forward that full correction into September by next week, in my opinion. If the lower range of the S&P is between 5,400 and 5,350, then I believe we're about there. However, I wouldn't be selling here. Do you believe that the change from August 5th to, say, September 5th was appropriate? Was it excessive? Was it based on fact? What are your thoughts? Well, it's difficult to tell. I am aware that the 3-day decline and the VIX's rise to 66 were the result of panic. We are aware that there was fear, but we also know that a significant amount of money was left over and used well into August. And since we know the yen was strongly linked to that move, I believe that part of this was a liquidity move. It's kind of happening again. Stocks have been under pressure as the yen has strengthened. Convince our audience that the market should be compensated 21 times earnings. That is the valuation as of right now. Even if everything is fantastic, that could still be exaggerated. I'm not sure, but it might not be. Make the argument that it's acceptable. There are, I believe, a few things for viewers. First, the Magnificent Seven is the reason why the S&P is at 21 times. Given that the 10-year is at 3.7, the median S&P stock is at 16 times ahead, which is not demanding. The 10-year is currently selling at a ratio of over 30 P/E. Therefore, you are paying a 30 P/E when you purchase a bond that you believe to be safe. Additionally, you can purchase stocks that are increasing 10% for 16 times earnings. In my opinion, stocks are a great deal right now, particularly since interest rates are being lowered and inflation is declining. So are you referring to the 493 when you suggest that stocks are a good deal here? Even as we ask ourselves, hey, is the economy a little slower than we think? Are they the ones you should be purchasing? Is the labor market deteriorating more quickly than we think? Yes, I suppose. In my opinion, the Fed's easing cycle is the primary reason why the 493 are appealing. Additionally, the typical P/E in the Russell 2000 is 10 times earnings if you look at small cap stocks. With little caps, you have a great margin of safety. Tech is undoubtedly a source of funding if people are concerned about seasonality, but I don't think it's a sell now. However, do I believe that by the end of this year, the Magnificent Seven will be lower? No, I believe it will be higher. However, it's difficult to tell when the bottom is. The issue is that, to use Rick Rieder's phrase once more, tech is recalibrating. But because we have concerns about the economy, you haven't been comfortable venturing into these other sectors over the past week. Yes, that is the investor's dilemma. Even though the growth rates are fantastic, they are still a little slower than they were. Should I buy the tech dip, or will the re-rating still occur? If we're asking ourselves all these economic questions, can you really trust the others? These are reasonable questions, Scott. Additionally, I am aware that Rick is an extremely diligent market observer, and he has noted that credit spreads have been extremely tight and stable. This indicates that the concerns about expansion are more narrative in nature. I believe the economy is headed for a soft landing, but those who are hard landing have some weapons. This indicates that stocks are overreacting to seasonality. Therefore, in the end, it's a purchasing opportunity. Unless, as some would argue, all of it is factored in. Rate reductions and soft landings are priced in, just like all the other positive news. In terms of the quantity of cuts and the overall amount that we will receive, the market may perhaps be a bit ahead of itself. What are your thoughts about that? What you're describing, I would think, is a significant market top. There are two things to remember. Even though I understand that people are afraid because it looks like 2007, since the advanced decline line reached its highest point ever, there is virtually no chance that the index has reached its highest point ever. And with tiny caps trading at 10 times forecast earnings, I'm very sure the major market peak has never occurred. All right, you went small caps before I opened it. I would like to use small caps. I'm not sure how many months ago it was at this point, but your major call on this show was that tiny caps go 50% higher this year. I asked you whether you still think that the last time you were on. You refused to back down and stated that the latter half of this year, which is already coming to an end, might still be strong enough for that move. Right, you still of that opinion? I do think so. Small caps, of course, have not followed and have been buried in the muck. Earnings, however, have been encouraging. In Q2, small cap profits increased by 19%. In Q3, they are expected to expand by about 40%. Fundamental acceleration is what that is. Even now, the P/E is 10.7 times ahead. Remember that tiny caps saw a 27% move in fewer than 20 trading days last year. Therefore, I believe small caps do receive the all-clear once the market is confident that the Fed is genuinely carrying out the cuts and they think we're in a gentle landing. Next week may provide some evidence of this. All right, so you made an effort to slightly hedge your bets by investing in both Nvidia and Broadcom. Discuss with me the transactions you made before entering. Yes, Scott, I believe that last week's thesis that Nvidia would be volatile was sound. The option markets were predicting a move of about 9%. It would be much simpler if you knew whether it would be up or down, but you simply never know. Yesterday, Broadcom experienced the same issue. A strong signal for an 8 to 9% move. We wrote a covered call with Broadcom yesterday, with a 1-week expiration that will expire on Friday of next week. However, the yearly premium we brought in was 60%. Now, I know that sounds absurd, but the hyper-volatility leading up to earnings is the sole reason. However, we earned $1.73 yesterday. On Broadcom, we wrote a covered call. By the way, we took in $2 during last week's Nvidia call. Since it has generated roughly $3 in premium over the last 2 weeks, we closed that out yesterday and issued another Broadcom call. Granted, the stock has dropped significantly, but in just the last 2 weeks, those 2 option trades allowed us to hedge 20% of today's decrease. Thus, it has been successful for both Nvidia and Broadcom. Since the equities are declining, I believe we should wait a little while before adding to them. However, I believe you'll get a chance to purchase. Additionally, Scott, we're seeing prices that are comparable to those we saw at the earnings. Pardon me, at the employment report last month when we saw the